The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. I'm Karen Cho with Sylvia O'Mara, and these are your headlines. President Trump's new tariffs on the so-called worst offenders take effect, with the minimum Chinese rate now at an eye-watering 104%. But Trump says the U.S. is stronger than ever.
Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was.
The global equity rout accelerates, with Asia sharply in the red, and Europe, along with Wall Street, primed for more heavy selling. And there's no safety in treasuries either, as yields spike.
More disharmony in the White House. Elon Musk and Peter Navarro's tariff feud continues to play out in public, with the Tesla boss calling Trump's top trade advisor, quote, dumber than a sack of bricks. Germany's leading parties reportedly stand on the brink of a coalition deal after marathon talks late into the night.
The U.S. has implemented its harshest tariff regime in over a century, with what the White House calls reciprocal levies coming into effect on countries from Algeria to Zimbabwe just over an hour ago. Futures are selling off both sides of the Atlantic, with investors also spurning treasuries. Yields are notching double-digit basis point surges on the long end of the curve this morning. Meanwhile, the offshore yuan is paring losses after it hit its weakest level on record overnight, as China grapples with 104% levies on goods sold to America. So a lot to unpick here on the yield and currency side. But in the meantime, speaking last night, President Trump was defiant on the issue.
The war with the world, which is not a war at all, because they're all coming here. Japan is coming here as we speak. They're in a plane flying, lots of them, all tough negotiators. But things that people wouldn't have given us 2 years ago, wouldn't have even thought of it 2 years ago, 3 years ago, 5 years ago, 7, they're giving us everything. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%. Now, it sounds ridiculous, but they charged us for many items 100%, 125%. Many countries have. They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger than it ever was. And 2026 Republicans will fight for every state, every seat, and every single vote. We're going to fight like hell.
Trump's Treasury Secretary Scott Bessent joined him in doubling down.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
So let's see how we're shaping up ahead of the open on Wall Street later today. Of course, it has been an eventful week for U.S. equities. At this stage, futures suggest it will be more selling later today when Wall Street opens. And this continues some of the negative moves we had witnessed also yesterday. So let me run you through the session on Tuesday. We saw the S&P posting its first close below 5K since April 2024, so over the past year. In total, the S&P was down almost 1.6% on the day. And it was interesting because at one point it seemed that we were changing the narrative for U.S. Stock markets, but in the end we actually ended the day on more negative notes. The Nasdaq also ended the day down more than 2%. And thinking about what this has meant for just the overall market narrative, it's important to take a step back and just try to understand what has been happening here. At first, many investors were actually thinking that there was room for compromise, that we could see perhaps the United States actually pausing this latest round of tariffs. Now there are growing questions as to whether we're actually going to see significant deals that could lead to at least some of these tariffs being actually cancelled. Let's see, we have to wait for that, but that is not the narrative at this stage. And that's why I want to take you to the Asian market session. In fact, we actually just obtained news from the Bank of Japan. They are saying that they will be holding a meeting to discuss the international financial markets with the finance ministry as well. Of course, this is very important here. We actually know that Japan seems to be ahead of the queue in terms of negotiating a trade deal with the United States, but no doubt that they are still very much focused on trying to put an end to these trade tensions with the US. But let's see how those trade conversations will unfold. No doubt looking at some of the moves in Asia, the Nikkei 225 at this stage down almost 5%, and more selling, for instance, for the Hang Seng, we're down 2% at this stage. Thinking about the European markets, let me show you how European futures are shaping up at this stage. Once again, they point to more selling in Europe. This is actually a contrast to what we witnessed during the session on Tuesday, Karen. We actually saw the Stoxx 600 gaining almost 2.7% on the day. But today, as we are looking at the so-called reciprocal tariffs being implemented, there's this new round of tariffs on European goods. We're talking about 20% additional tariffs. Of course, investors looking at this and questioning whether there's actually room for negotiation, and of course what this means for the economic outlook.
There have been waves that the market has been dealing with. First the threat of the tariffs, then the impact of the tariffs. So as we talk about today, we're now seeing the impact of the tariffs. So what do businesses do? Do they try and stockpile? Do they try and get around the tariffs in the hope that they will be removed through negotiation? Or is this now starting to get passed on because it's hard and fast coming into effect today? That is one point. The other point is the market moves we saw yesterday. The commentary that Trump had that China wants to do a deal. This was very positive for the market action. I think what you're saying is that the market, if it gets any decent news flow, will be ready to rally very aggressively. But in the meantime, we now have an extension of the downside in a very almost disorderly way, because we've moved away from very violent selling on the stock market, and that, let's face it, that is still unfolding, to also now seeing disorderly moves in Treasury markets. So typically, if we're talking about some sort of fall economically, you would see those yields decline. That is not the case, and some are also viewing the outing that we had from the Fed the other week from Powell, that this was very hawkish in the context of what we're seeing unfold, as well as whether there is some form of a buyer's strike. There is action from those now not wanting to hold American paper because of the disruptive effect of the Trump administration. So that is something that you cannot write off. The other factor here we'll throw into the mix is whether we've got some sort of currency warfare unfolding through the lens of the Chinese trying to depreciate the currency. So again, these are incredibly violent waters, not even choppy, they're absolutely violent territory.
I also want to go back to the point of what this means for the Fed, because I'm wondering what are they going to do? They have been very focused on inflation. They keep saying, of course, that obviously these tariffs are inflationary. They're going to bring even more inflationary pressures for the U.S. economy. But then if we see a recession, what is the Fed meant to do? Do they hike? Do they cut? What is the right balance for the Fed here? And I'll just make one final point that, these tariffs are already having an impact on the economic outlook and on real lives. I was in Italy over the last couple of days. Wine sellers, they export heavily into the U.S., telling me that American importers have paused orders for now in anticipation of today's round of tariffs. And what are they going to do? They're like, American consumers will be paying more for their wine, and they are looking at other markets to sell their wine into.
Well, that's in the inflation expectations. Americans now expecting, I think it was 75% now, expecting that prices will be higher from here. But in terms of what the administration wanted, we got the message loud and clear that they don't care about the stock market, that there could be some medicine for investors to swallow here. And it doesn't feel like medicine. It feels like some sort of a drip that markets are now on, some sort of life-saving drip as they battle that out on the markets. But what the administration does care about is the 10-year yield. And what we've seen since just in recent weeks, the 10-year yield is now above the 410, 420 range it was on Liberation Day. And of course, it's also rallied since last year. So the administration is not getting what it wants in terms of bringing down that 10-year Treasury yield. You can see this morning, 4.43%.
That's right. But let me get you up to speed to what's happening in terms of some of these trade conversations. U.S. officials say that allies, including Japan and South Korea, will be given priority in trade talks. In fact, South Korea's trade minister is traveling to the U.S. after a call between President Trump and South Korea's acting president, Han Duck-soo, with Trump saying he's optimistic a deal can be reached covering trade and payments for the U.S. military presence in the country. Meanwhile, Japanese negotiators are looking to begin talks with the U.S. administration in the coming days, with President Trump saying he would seek tailored deals. Kaori joins us from Tokyo with more. Kaori, great to have you on the show. Perhaps just explain to us what we can expect from these conversations, where there's any indication that a feasible trade agreement is actually on the table.
Well, I think we're very far from that. But compared to the rhetoric that's coming out from the U.S. administration in regards to China, the U.S. Trading people are sounding very optimistic about their negotiations with Japan. I mean, take a listen to what Scott Bessent had to say overnight to CNBC.
The Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
And in this wide-ranging interview, he goes on to say that there could be a deal in terms of LNG, the Alaska project that's been very, very costly. He's saying that maybe the Japanese could provide some capital for that. So compared to the rhetoric that we're hearing with other trading partners, I think Japanese authorities here are relatively positive in the sense that they have first mover advantage. But that is not to say, of course, that the economic impact is going to be any more muted here. I mean, I'm hearing numbers from between minus 0.3% to minus 0.8% impact on the GDP if these tariffs are in place for the next year. The other factor to consider is what does it do to monetary policy? And it's interesting that news reports are emerging that the Bank of Japan and the Finance Ministry will be holding a meeting in about 2 hours' time, so just after the market closes. It's not entirely unusual in times of huge volatility like this for the central bank to meet the finance minister, but given that the Bank of Japan is in a very delicate situation. I mean, before these tariffs, the talk was normalization. When are they going to raise interest rates? I mean, I would be very interested to see what the official comments are from both sides of this. But I'll just update you on the government comments so far this morning regarding these trade tariffs that kicked in. Look, the chief government spokesman, very, very muted, very, very measured. He's saying he's going to strongly urge the U.S. to review the measures, and they're going to discuss thoroughly without giving up. The foreign minister, Mr. Iwaya, telling Parliament that, look, free trade is in the benefit of the U.S. as well. So this is the point that they're going to be pushing. So this is an all-Japan effort, not just the trade minister, not just the economics minister, but Japan Inc. as well, because you have to remember cars are a big component, 25% tariffs, not only going to hit Toyota and the rest of the major automakers, but the thousands and thousands of small and medium-sized enterprises that are going to be hurt if these tariffs indeed stick. Guys?
Kari, thank you very much for bringing us the latest there out of Japan. Kari and Joji with us. Meanwhile, long-term or long-dated US Treasuries are continuing to sell off this morning, with the 30-year yield breaching 5% in early trades. Our next guest says that if this selling continues, we could see an over-leveraged player seek a hasty liquidation as the financial shock unleashed by the new trade regime intensifies. Let's get to Joe Brusellas, who is the chief economist at RSM. Joe, thank you very much for joining us. We are seeing very strong moves now on the bond market, which is not going according to script. Just walk us through some of the pain trade that you think could unfold from here.
All right, so essentially what's called the basis swap trade. That's a leverage trade that's quite popular amongst the hedge fund community, is blowing up this morning. It's the gap. The hedge funds like to trade the gap between cash treasuries and futures. Unfortunately, right now, that's rendering the treasury market illiquid. The massive market volatility caused by the U.S. trade regime is now blowing up that basis swap trade. That's why you've seen the 10-year move to near 4.45 and the 30-year above 5%. It's well understood that under these conditions, you're going to get a hedge fund that's likely going to run into serious problems. And the lateral pressure could create issues for private equity and private credit funds. And we all have the memory of summer 2020 when this occurred, and it forced the Fed actually to step in to improve liquidity conditions. And of course, in 2023, when yields surged above 5%, at the long end, we had issues in local and regional banks in the United States. So right now, whatever the administration thought they were going to obtain by launching a multi-front trade war, it's clearly not working. It's now time for the administration to seek a near-term off-ramp. If they don't, we're likely to see this roll into Europe and into the North America session with much more pronounced losses, not just in equity markets, but now that the location is moved into global fixed income markets, that's where the real game is. That's got to get the attention of the administration here.
Joe.
And if they don't get on it, but we're going to have a much bigger issue.
Joe, if you're talking about a liquidity event here, we've been here before in history. Do you think the Fed, if this happens, is as willing to step in given the confrontation it's had recently with the administration?
The Fed's has got a horrible decision it's going to have to make here. We know that on the backside of this, that both inflation and unemployment are likely to rise. My sense is right now, even with the dysfunction I'm beginning to see in the market, it's not sufficient yet for the Fed to step in. It's likely going to have to get somewhat worse. Look, if a central banker has got pressure on both sides of their mandate, that's the mandate for maximum stable employment and price stability, they're likely to lean in the direction of price stability, which means they're going to be very reluctant to intervene. But again, sometimes you get overtaken by events, and the Fed will probably just want to manage one crisis at a time. This is going to be a multi-day phenomenon. It's why I'm sitting here in Austin, Texas this morning, just after 12 midnight, up talking to you guys in Asia and in Europe.
Joe, I would like to understand, and I appreciate this is a general question, but what is next for markets? Because we have seen such heavy selling over the last week or so, some actually wondering whether this is the moment to buy the dip. My question is, where do we go from here? For how much longer could this heavy selling continue for U.S. equities?
Well, I'm an experienced veteran of 2008. This could go on for much longer. That's the unfortunate true answer to your question. Until a floor is put in, meaning either the Fed and the other central banks step in and provide liquidity, and that may not necessarily stop the problem here, because the origin of the shock lies within the trade regime. That's the real issue. We're going to need to see the White House find an off-ramp, take it, and then allow this to calm down. They can negotiate, that's what their actual goal is, while things are much calmer. But for now, this is just going to continue, unfortunately, until we get to that day when the White House recognizes this is no longer tenable.
So what about the dollar?
Well, under these conditions, you would expect the dollar to weaken. It really hasn't over the last number of days. It's not moved much. But I get where you're coming from. It's hard for the dollar to retain its currency reserve status if one cannot trust the trade regime that's been put on by Washington. That's why we're having this discussion right now around, hey, are we going to continue buying dollars, or are we going to have to diversify our reserve? Now, my sense is the U.S. economy is too large. You've got the $30 trillion liquid U.S. Treasury market. And as this slows, the dollar will keep its status. But for now, I would expect more volatility, not less, across fixed income currencies and commodity space, in addition to what we're seeing in equities.
Joe, I want to come back to the yield curve a bit more, because we are seeing, of course, that increase at the 10-year. The market has been looking at how the Trump reciprocal tariffs were derived, and there's been a lot of pushback as to the methodology used, and some saying that is now weakening the process around support for US assets. And we're seeing that even in the safest of safe trades. There's a feeling too that, look, treasuries could be weaponized. The Japanese may not be going there, but China could be. What do you make of the administration's ability now to meet some of those interest payments, and whether there's even more heat economically on the US when these tariffs were designed to take the heat off the US fiscal position?
All right, well, the administration can make the interest payments. That's not really in doubt here, okay? I just want to be very clear about that. The U.S. can make all its interest payments. The real problem is that we've had a loss of credibility and confidence in the administration's ability to actually execute on this, which fundamentally started with that nonsensical equation that was put forward. Look, within minutes, we had already solved for the Greeks on my team, and we realized that this isn't a reciprocal set of tariffs. They're actually punitive. And that's at the heart of what's driving all of this volatility. And why you're asking me questions about the dollar and making interest payments, which heretofore nobody would have ever questioned, right? Look, we are not having a financial crisis in terms of we're not having a dollar funding crisis. We're not having a situation where the U.S. isn't going to meet its obligations. It will. But right now, what we've seen is a loss of credibility due to an inept execution on the rollout of the trade regime and that unfortunate equation that was put out, which quite frankly just didn't sum up.
Joe, I'm afraid we have to leave it there, but thank you for your time today. Joe Braswell is chief economist at RSM. Now, President Trump says he will expand the impact of his tariff policies with the pharma sector next in the crosshairs after being exempted from so-called reciprocal tariffs in place from today.
We're going to be announcing very shortly a major tariff on pharmaceuticals, and when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here, and they're going to be opening up their plants all over the place in our country. We're going to be announcing that, so that's breaking news. Ladies and gentlemen, we have breaking news.
European pharmaceutical companies have warned that tariff policies could accelerate a shift in investment to the U.S. A sector lobby group has called for, quote, rapid and radical action from the EU to avoid what it describes as a risk of exodus. Coming up on the show, the US and EU relationship is in focus as Giorgia Meloni gets set to meet Trump next week. We'll discuss more after this break. Plus, tariffs take a bite out of Apple as Microsoft overtakes it to become the world's most valuable company by market cap again. And in the wake of fresh tariffs on China, we'll get a read on the EU's trade outlook with Bernd Lange, chairman of the Committee on International Trade at the European Parliament. Do not miss that conversation coming up at 7:30 British Summer Time.
New Zealand Central Bank delivered an expected 25 basis point of rate cut and left the door open to further cuts as global economies feel the impact of President Trump's tariff policies. The question is how many more follow suit as the Reserve Bank of India also reduced rates by 25 basis points and adjusted its monetary policy stance to accommodative from neutral. The central bank's governor said US tariffs have added to uncertainty. Also discussion as to whether the ECB could be next off the block when it moves to meet next week. Now, the sell-off is continuing in Asia as Trump's 104% tariffs on Chinese imports come into effect. JP joins us with more on the Asian market moves. JP, we are seeing extraordinary dislocations and the dollar weakness is dramatic at a time where you would think there would be a flight to safety, plus, of course, the bond market. So what are you seeing across on those Asian boards today?
Well, Karen, good morning. And it doesn't seem there's any safety to be found actually in Asia. And it seems that the Tuesday rally, at least, was very short-lived based on how equity indices, the major ones from Tokyo to Taipei, are pulling back in significant fashion. We do want to start with Chinese markets, which you're seeing here actually on the board at the moment. And there was a sign, at least, that the Shanghai Composite was actually trading slightly in the green. Also hints, perhaps, that the national team or some of these state funds were coming in to prop up stocks. But as you can see here, the Shanghai Composite has now fallen to the red. The Shenzhen Bourse trying to mount a slight comeback so far, and the Hang Seng also in the red, down by about 1.8%. It's because those tariffs now, effective today, seem to have doubled at least on Chinese goods, effectively about 104%. We also want to take a look at how the Chinese yuan is trading today, because we did hear from President Trump where he singling out the yuan and saying that China might be manipulating their currency actually to, in fact, better trade deals at least, or a better trade outcome for them actually. And we're seeing that the yuan, both onshore and offshore, are moving in odd fashion so far in today's session. In fact, moving so oddly that even my screen right now is flickering, as I can see. The Nikkei 225, also something to watch out for because of how it's pulled back and how it tried to rebound on Tuesday. But you can see it's back to losing ways, with the yen also looking a bit firmer today, and the Nikkei now back firmly in bear market territory. The banks are worth watching out for in Japan also, because they're moving almost as volatile in as much volatility as the Tokyo benchmark. We did hear from Nomura where they said that the full implementation of the tariffs in Japan could bring down their GDP by as much as 0.6 percentage points again, which means that the talk of recession fears in the world's fourth largest economy continues to resurface and continue to intensify by the day. Across the rest of the region, we're all seeing significant pullbacks. And once again, the TAIEX also the market to watch, because they are seen another day of punishing declines today, with the TAIEX also the latest in the markets actually to enter bear market territory. And there's nowhere to run, nowhere to hide so far on this Wednesday here in Asia.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.